A lot of companies are trying to transition to net zero or better environmental practices, and it can be quite lucrative for a fund manager to actually go on that journey with those companies as the market sort of starts to realize that this company that perhaps didn't meet a lot of ESG criteria at some point in the future has become very ESG friendly and therefore is attracting more interest and more investment.
Welcome to The Greener Way. I'm your host, Rose Mary Petrass, Senior Journalist at ISS Sustainability. We are recording on Gadigal land. We pay our respects to traditional custodians of country and elders past, present and emerging. When it comes to investing, information really is everything. Finding the right ESG investment product that delivers returns alongside positive impact while sidestepping potential greenwash, unethical or risky business practices can be a rocky road. Whether you're an institutional investor, a wholesale investor, or a financial advisor. Here to shine a light on the right path is Aman Ramrakha, with almost 2 decades of experience leading research across banking, ratings, and governance solutions. Aman recently started as the new Executive Director of Research at Rainmaker Information. For those listeners who are not aware, Rainmaker Group is owned by ISS STOXX, publisher of ISS Sustainability. Welcome to the show.
Thank you for having me.
What are the basics of researching investment products, whether for institutional investors, wholesale investors, or financial advisors?
I think at the heart of it, the process is very similar, regardless of, I guess, the end purpose of that investment, whether it's a super fund looking to invest in a fund manager or an advisor looking to recommend a particular fund to their clients, or for that matter, a self-directed investor seeking out the best fund to invest their own assets. The ultimate process is the same. A lot of it is very much based on the people. So if you can think of who are the people running the assets on behalf of the investor, what kind of skills, experience that they have, the size of team, the resources that they have available to them. The second probably part of it is the process. What kind of process do they use? How do they sort of filter what can be a very vast universe of companies or debt instruments to invest in? And how do they narrow that down? So you want to pay attention to what that process is. It repeatable? Does it work? Things along those. And then probably the third piece is the organization. Is it a stable organization? Is it a organization that will be around, particularly for the time horizon of many investors? And we know that superannuation investors in particular have a very long time horizon. So you want that organization to be there for as long as you need them to manage your money. Other things like fees, past performance are also important factors to consider the validity of that investment.
And when it comes to researching ESG investment products, are there additional factors to take into consideration?
Absolutely. And I think first and foremost, this notion of investment merit should be at the forefront of any analysis that ultimate investors or intermediaries should do. So you want the skill of the investment manager to be assessed first. And that skill is very much based on what I've previously mentioned around the people, and in particular the people in their process. And that should be at the forefront of anything you do, even before you start to consider ESG. It's important to have both that investment skill plus a good ESG process. You can have the best ESG process in the world, but if you don't have that investment skill, then the likelihood of good outcomes starts to diminish. I think that's something that a lot of investors perhaps don't pay attention to. They sort of look at it from an ESG perspective and think, okay, that's good ESG. We think that fund manager has captured what we're looking for from an ESG perspective, but perhaps they don't then pay enough attention to the investment skill. I think that's an important thing that most investors should take care. In a perfect world, you get both good investment skill and good ESG practices. When it comes to analyzing the ESG practices themselves, there's a whole bunch of things you can do, but you can probably distill it into sort of three things. Managers that work under some sort of ESG banner generally have three decision points when it comes to investing. They can either avoid or exclude in the first instance. They can divest, particularly if it's an existing holding and something changes, or they can engage. And that, in a simplistic sense, is sort of the crux of ESG investing, particularly divesting. The sort of nuance between avoiding and divesting is an important one. Quite often what happens is if you are already invested in the company, and something changes and it no longer meets your ESG framework, you then have a opportunity to either engage the company or simply just divest. And those are important decision points that fund managers will make, and it's important for investors to understand that. Engagement is probably perhaps the hardest thing for fund managers to do. It requires them to influence companies on their behavior and ask them to change their business practices. But you do see a cohort of managers willing to engage, particularly when it comes to things like transitioning. A lot of companies are trying to transition to net zero or better environmental practices, and it can be quite lucrative for a fund manager to actually go on that journey with those companies as the market sort of starts to realize that this company that perhaps didn't meet a lot of ESG criteria at some point in the future has become very ESG friendly and therefore is attracting more interest and more investment. And if you've been there for that journey, you can actually get quite a good reward.
You've been in research since before ESG was a thing. How has the industry evolved to arrive at this place? And do you think ESG is here to stay?
I think the evolution of ESG has been driven, like many things, initially by institutional investors, as particularly endowments, superannuation, or even sort of state-owned pension funds. They have, in their sort of understanding of their fiduciary duty, have started to think about things along ESG spectrum. It's fair to say that ESG has always been part of an investment process, but you sort of had a scenario where governance was probably the most important. If you talk to fund managers 20, 30 years ago, they would have been very much focused on governance. Is the management good? Is the board good? What kind of governance processes? Do they treat their shareholders appropriately? The E and the S were probably lesser of an issue. And some of that was because data or analysis wasn't available. But I think it's fair to say that it started sort of in that institutional space as institutional investors became much more aware of their fiduciary duties. And then perhaps in more recent times, there's been a groundswell of investor interest. Many people are thinking about things like climate change and the impact it has on their investments, where they're invested. They become a lot more aware of where their money is, whether it's their superannuation or their own investments. And they've become perhaps a little bit more informed by what's out there in the media in terms of what it is that's happening and what companies. And so you're getting a lot more information around companies that are doing well or doing poorly in that sort of ESG space. So you sort of had institutional starting, more recently retail investors pushing that sort of bottom-up demand on what ESG is. The interesting part of that is what ESG means to individuals can be very different, and what's available in product land can also be very different. So one of the difficulties in that sort of ESG space is defining what ESG is. It could be as simple as an exclusion. So all the nasties are taken out of your portfolio. There's no tobacco, there's no munitions, there may not be alcohol, things like that. So that might be enough for some investors just to screen that piece out, whereas others will want a lot more from their investments in terms of social impact, climate change, and things along those lines. So you've got a very vast spectrum of what you could define as ESG, and it can be problematic sometimes to try and find something that fits your own personal beliefs, because at the end of the day, some of it is very much led by individuals' personal beliefs. Whether it's, I guess, structural or cyclical, we are seeing plenty of evidence, I guess, to date has been, particularly on the performance side, that it is cyclical. You've seen ESG perform well, you've seen ESG perform poorly, and generally it's sort of linked to the resources cycle. So when resources are doing really well, ESG investments tend to do poorly and vice versa. And we've seen that, I guess, through the pandemic and in more recent years where ESG performance has not been perhaps as good as it was in the past. I think one of the simplest ways to look at ESG and whether it is something that is going to be structural in the future is very much along the lines of sustainability of companies. At the end of the day, if you're a company or you're the board and management running a company, you want that company to be around for a very long time. And in order for companies to exist over very long periods of time, they generally have to not do things that damage the environment or have poor governance practices or treat their customers badly. So generally speaking, companies that succeed will and should have good ESG practices already sitting inside them without the need to have them specifically call some of that out. It would be rare for companies to survive long periods of time if they are performing poorly in that sort of ESG space. There's more people willing to call them out. There's more activist action that will force them to change their behavior if they're not doing well. And ultimately, the flow of capital may move away from them in that environment if they're doing poor practices.
From your perspective, where do investors or advisors most commonly get it wrong when it comes to researching ESG investment products?
I think the simplest way that they do get it wrong is relying on a label. One of the difficulties that I mentioned is defining ESG. So to some extent, investors or advisors can fall into the trap of just simply relying on a label. The fund has ESG in its name. And so there may be some element of perhaps clever marketing of products along an ESG spectrum. You mentioned greenwashing in your intro, and we've seen some evidence where the label doesn't fit how the money is managed and how it's invested. So I think that's probably the first area that investors and advisors can get it wrong, just simply relying on a label. The other sort of piece of the puzzle is, again, to my earlier comment about focusing on the investment merit of the team running your investments or your clients' investments. I think that's another area where investors can get that wrong. Again, relying on a label, relying on perhaps what appears to be a very good ESG process, ticks all the boxes that I'm looking for, focuses on the right areas, but at the end of the day, the people managing the money may not have the skill to do so in a manner that means that I'll get a good investment outcome. And I think the last sort of piece of that is understanding what ESG can and can't do for you. Like a lot of investment decisions, there is quite often a trade-off. So if I do want to invest ESG, particularly if I have some specific requirements of what type of ESG I'm looking for, I have to accept that going down that path may exclude certain parts of the universe. So as soon as I start to, and it's true of any investing, not just ESG, as soon as I start to think about narrowing the universe of options that I can or my fund manager can invest in, I have to accept that there'll be some trade-off. Hopefully good trade-off. In many cases that is true, but as market cycles happen, as macroeconomic factors can impact all investments, you will see times where ESG might underperform. So understanding that ESG can underperform for periods, just the same as other factors like growth or value can underperform over cycles. ESG will have some similar characteristics. And so noting that, understanding that, and going into it, accepting that are things that investors and advisors should make sure that they understand.
I think we have time for one more question. How do you see artificial intelligence influencing research or research methodology in the near future, especially with ESG?
So AI, and I'd sort of preface that by saying perhaps things like quantitative analysis has always been a part of investment research. It's always been there, and the weight that you put at it has probably depends on how you're doing your research, and so I think that AI in the first instance will play a part in that. There is a wealth of data that you can access on performance, and there's sort of many ways you can analyze a fund manager's performance. There's a whole bunch of financial ratios you can run them against. So there's a wealth of quantitative data available that can be analyzed to determine the merits or otherwise of research. And so AI has played some part in that, and I suspect will continue to play a part in that, and frankly make that quantitative process a bit more robust. When it comes to ESG, the issue sometimes is the availability of data. So right now, I can get my hands on a lot of data on any given fund manager to analyze their performance and their investment merit. What is less available right now, and it's getting better, is data along ESG lines. The consistency and availability of that data is something that the industry is still grappling with. What form it's reported in, and so being able to, and I think to some extent AI may help in being able to analyze and scrub that data and put it into some sort of consistent form. So I think AI may have some place in that piece, but the availability of that data is something that's still, whether it's company, whether it's fund manager data, is still something that's in very early stages. Big companies are good at it. Smaller companies are probably not as well resourced to provide that data, and probably the same of fund managers. Big fund managers can do it better. Some of the smaller ones may or may not be able to produce the level of data that's needed for something like a generative AI tool to start to analyze it.
Thank you so much for your time today, Aman. Where can people find out more about Rainmaker?
Certainly through our website. So Rainmaker Information is our website. They can find out more about it, and our sort of flagship tool, which is Rainmaker Live, has a lot of information around both the superannuation, the managed funds industry, and so there's a wealth of data and information available through that.
I'm Rose Mary Petrass, and that's a wrap for today.
The Greenaway podcast is a product of FS Sustainability, a show about people, the planet, and investing in our collective future. All information in this podcast is for education and entertainment purposes only. The Greenaway podcast gives listeners access to information and educational content provided by discussing numerous financial sustainable options and our featured guests. It is not intended as a substitute for professional, legal, or tax advice. The hosts of The Greener Way are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.